What's up, outliers? A new day, a new Fed rate cut, and the market is hovering at all-time highs, despite the fact that we are in the throes of probably, my guess is going to be the longest government shutdown in history. We have about another week or so before we hit that mark. Based on how it's going, have to assume it's going to get there. The goal for the stream today is just poke through some interesting things in the market right now and to just talk about stuff in general. There's a few things that are quite top of mind for me, especially as we're going through earnings season. So for those that don't know, I spend a lot of time and effort trading earnings. It's a big part of my book, but beyond the trading side of it, earnings is literally always an absolutely awesome place to get a proxy of how companies are expecting things to go in the future because of the good old forward guidance section. Now, the other thing I want to touch on really fast, last night, we were working on an updated strategy scan that I started running live not that long ago. And I'm looking, standard ways to optimize it slightly. It's essentially a glorified momentum play, but reversion based. So far, that has been kind of a fun project. I find market cap has like a really high correlation between the forecast potential of the metrics, which I find a little bit interesting. Now, if we take a look at the market as a whole, there's effective perpetuation of some key themes that we've been paying attention to. One of which is we're still seeing weakness in energy. Financials are also dropping off. Big continuation in real estate, and then also staples. That has been a little more aggressive than I thought. And then if you take a look at the percentage of companies in the S&P 500 above their 50-day moving average, that's actually getting real low. Right now, that's at 41%. That's bad breadth. Not terrible, but not good. So if we take a look at a couple things a little more in detail. We'll take a look at this one so that you can see breadth. Breadth is still okay, but it is accelerating to the downside. So if you take a look at gross lows for both NYSE and NASDAQ, they're both peaking to the downside. Now, this isn't the worst that NASDAQ has seen, but it's within striking distance. It's definitely within the top three that we've seen. Now, as always, just because breadth starts to slow down doesn't immediately lead to a turnover. However, one thing that you will note that if we overlay price behavior with these down spikes, you will see kind of an interesting behavior. So I'll kind of crunch that up so that I can add first cues here. And then I just want you to overlap, right? What's happening here? So this is where the prior gross lows were turning down, and take a look at what happened to price. It's this big red down day here. Then we have another semi-peak in gross lows here, followed by really effectively nothing. Then there's another downside peak here, gross lows, followed with net highs, lows turning negative. That's associated with a down move. What I'm highlighting is that this kind of signal is not perfect. That's why I explicitly do what most other people that do this kind of thing, meaning talk about strategies and talk about technical indicators. I don't just cherry pick the instances where it worked the way that the indicator is supposed to work. So for example, this point here, where it definitely had a gross peak to the downside, that still was, again, effectively nothing. That will happen sometimes. But in mass, we can see that typically speaking, we do see a little bit of a pullback underway, especially when this is accompanied by both exchanges, both NASDAQ and NYSE. Because here you can see that this peak to the downside is both. This is not. This is just NASDAQ. Then this peak to the downside again is both. This peak to the downside is also both. That's another thing you have to pay attention to when you're using different kind of breadth indicators. Again, there's nothing magic about any of this stuff. This is effectively just looking at momentum in mass. But this is not normal to see gross lows dropping like this while the index itself is effectively ticking new highs. That's weird. Doesn't mean anything right out of the gate. I have a list of assumptions that I make off of stuff like that turn into trade ideas. But the most important thing is just to help you see these deviations. And then, as always, it's up to the individual trader to figure out what they mean to you, how it might fit into your broader trading approach, and so on and so forth. But what I can say unequivocally is that that's not normal, and something I'm definitely paying pretty close attention to, especially because the levered covered strangle in something like TQQs is mega highly sensitive to stuff like this, super sensitive. So I have to pay pretty close attention to downside rollovers in that strategy. Otherwise, it's very easy to start giving up a lot of profit that otherwise was realized. Similar thing is going on in Palantir, actually. So I have a ratio call diagonal that I took down in here, and then I reestablished it here. So that's been paying out pretty well, but this past period in Palantir had been rotating sideways for some time. I had like a series of positions that I scaled out, scaled in, took the rest out, and then re-entered more directionally. But these digestion phases are super normal. It does create an additional transaction when I get out on stuff like that. But that caginess is kind of how I hold on to profits on stuff like this, because if you don't remember, when markets tend to turn down, they really tend to turn down pretty quick, especially based on this new paradigm that I've talked about quite a lot, actually. The new paradigm being when I look at things like average true range, average daily range for the indices, and I compare those not against to like near-term historic differences, but long-term. Overall volatility on a daily time frame is up pretty significantly compared to 20 years ago, 30 years ago, and so on and so forth. That leads to these really interesting price patterns that we see every once in a while that just cause these really quick unwinds. And then on top of that, we're in apparently life is a fucking simulation because of the characters we have doing what they do, one of which is big old DJT that will drop a tweet once in a while and just shake everything. That's difficult for markets to try to conceptualize and fully track risk. It's not as quiet as a period. And you can see that represented in the fact that VIX remains slightly elevated here. Now, again, this is elevated against historic norm. I still argue that the VIX is a little low compared to where it should be. Now, should is always difficult to identify, but I do think if you stripped out all of the ancillary market activities that include VIX that cause artificial suppression of VIX price, that you would actually see nominal VIX a little bit higher. And sometimes we can see that in the volatility surface when we're looking across in S&P on longer term timeframes. That has been something that it's something that it's like really difficult to get to the bottom of. And I'm actually not even really sure that there's a massive purpose in it other than I'm so fucking interested to try to understand those forces better. But besides that, like, I really don't think that there's some sort of really big payoff to trying to get to that level. That's one thing that's really difficult to wrap your mind around, I think, depending on where you're at in your trading journey. Is there really is a big difference between the shit that's like practical and you kind of need to know it in order to do stuff, and then the ancillary stuff that people will talk about because people become autistically interested in this, like myself, and that'll start to lead people into believing that like you have to do a bunch of this other stuff that may or may not actually net add value. That's always a individual thing that each trader has to figure out, like what kind of context really drives decision making. But this movement in the VIX has been bizarre, and that leads to another interesting series of patterns, because today I was trading 0 DTEs. Now, this is actually a very, very interesting series of trades that I want to talk to you about, and it has a lot to do with how the market behaved. It's a great example of changes in vol and how those changes in vol can impact a position. So let me show you. Okay, so this is a daily. We don't really need 1 minute. It's a little overkill, but you'll be able to see the patterns a little bit more clearly. Okay, so earlier today, I'll get the exact time for you right now from the platform. I don't remember the precise time, but I want to be able to take you to the minute that I put the trade on. All right, where you at? Would be somewhere in here. Okay. So the first trade went on around 11:09. That's when I started to phase in, which was in here. And the reason for the delay, there's different timings. I had other stuff that was going on the day. I'm talking about a very specific piece of the broader trades for the day, specifically 0 DTEs in indices. This was shortly after Big Daddy J Powell started, well, the Fed rate statement before the press. Before the presser started, which you can see exactly how that went. This went on, and then I scaled into it slightly, and I held it for a little bit. And then I'll tell you when I ended up coming out of it. I ended up coming out of this at 11:50. 11:50. This was a short straddle. So 11:50 is right here, which, funny enough, would have been fine leaving it alone. But I came out of it here. Now, when I first offered the straddle, it was at like 69.05. This is now down at 68, call it 68.75 or 68.73-ish. For something on a 0-day time frame, that's a pretty significant move. And typically speaking, what happens during these down moves is the puts quickly gain more delta, the calls quickly shed their delta, and the trade becomes skewed very, very fast. This is everything to do with the short-term time frame and the play of gamma. Now, funny enough, that trade was able to be pulled down for a very small loss. It was about $1. I'll tell you right now. Where the fuck is it? Was $1.22 loss. Even though there was an absolutely profound delta move against me. So for context, again, if I show you roundabout, like the actual movement from there to there, that's about 0.5%-ish. Now, again, that doesn't necessarily sound like a ton, but on 0-day timeframes, that's not insignificant in something like this. So if it were not for an accompanying absolute spike in vol, then that trade would have effectively just sat at a moderate loss. The reason for the management on this on the time frame is because I figured that there would be a better time for me to just rebalance my deltas. So I took the trade down not to stop the bleeding, not because it was losing money, not because I wanted to get out because I thought it was going to go against me. It's literally just because I acknowledged the fact that when I sampled vol, the realized obviously exceeded. That's clear as fucking day. The thing was buried as it should have been. So all I did was take advantage of that spike in vol to come out of the trade for a very small loss and then to recenter. And that's exactly what I did. I just recentered the straddle and then I took it into like 2 minutes before expiration. And then I did also take that trade down early. Normally in that kind of remainder of the setup, I wouldn't have done that. But in this context, because of how much this thing is moving, it can throw something out of a profit zone, especially with the straddle, very, very quickly. Because again, remember, even this last minute of a candle, the range of the last minute candle was 68.86 to a close of 68.92. So that move itself is significant enough that could take something that's at a moderate profit, decent profit, and it could effectively knock you out of it, essentially because we're already out of where I needed it to be because of where the straddle was recentered. So I was able to actually take that second trade down a few minutes before the close at a healthy profit. Again, slightly different than what I typically would do because you almost have to take them into expiration at that point in order to get your money out. But there was so much vol that came into these that led to, and again, you could see the vol, right? Look at how this movement looks in this time frame compared to this time frame, right? Like this is a great visual of vol. And this is really, really fun trading conditions for 0DTEs because the total amount of risk that you're taking, even though things tend to move a lot, you're also compensated very well. So when I'm trading zeros on stuff like this, I tend to be way more mobile with what I'm doing. And it's to try and extract out as much as I can, understanding the fact that if there was no management, the trade essentially just would have sucked wind most of the day. Definitely would have come down at a loss. Pretty fun change of pace thanks to JPOW. Now let's talk about what happened with the Fed and the market's response, because the market got what it wanted, yet we saw a very interesting reaction in the yield curve. So now, if we take a look at the 10 Dece meeting, I want you to look at now the probability of no change for December. That's ticked up from effectively 0 probability of no change to now a third. Powell talked a lot today about kind of about nothing if you listen to it, but the main stuff that he reiterated to his credit that he's been very, very steady on, especially the fact that we're getting to a point where we haven't fully seen all the pass through of all the different tariff policies. All that kind of stuff is yet to fully trickle through the system. And then we have the government shutdown on top of that, which adds absolutely a confounding factor. So I think that there is a good chance, if we take a look at the actual probability matrix, there's a good chance that we might get another cut, which right now, majority probability in December. But then it looks like we kind of stall there for a little bit. Whereas before, this was actually looking at subsequent cuts. pretty high probability. That's changed. When we look at the news, I don't know if you guys saw, Trump was going to talk to President Xi, and there was conversation about potentially easing some of the tariffs related to, the fentanyl. And I don't know where that landed. I don't know if you guys saw the news on it, but I didn't see where that ultimately landed. But that kind of thing adds more friction to stuff like this. And it's because it's just more variables. Like, we don't know if those tariffs are going to stay where they are, which has a completely different impact than the way that the tariffs are generally being used, which is to coerce behavior. And that's effectively why they're out there, not for some broader economic ploy. I'm sure if there was an easier way to get the desired outcome quickly, that would have been done. But right now, tariffs are seen as the quicker way to get there. And to some effect, I think it objectively is fair to see, to some effect, we have seen impacts from it. Now, how significant those are against the rest of the picture, obviously, that's all up for debate. The next thing I want to talk about quickly, and then if there's anything that you guys want to take a look at, like I said, this is a perfect time. I'm getting to the end of like the specific things I want to talk about. I want to touch on tech really fast, but then after that, we literally can dive into whatever you guys want. There was a couple questions that I got in the Discord that I want to talk about, and then whatever else you guys want. So for the last main thing that I wanted to talk about was tech. I want to see actually from here if there's anything specific about NVIDIA on one of these. I thought for sure. Oh, here it goes. Two things are super interesting. If you saw Google had earnings, and it says Google's corporate parent on Wednesday announced first ever quarter with more than 100 billion in revenue. Just like think of that for a moment. I'm actually curious if AI can make like a visual to help visualize what that is. Create a visual to help contextualize vastness of 100 billion. I'm super curious. It's probably going to be absolute trash what it comes up with. Yeah. I mean, it's pretty, but this is absolutely useless. Cool sky pics. That's neat. It's not dialed in yet. We're still working through some issues with that. Funny enough, I actually asked it for help on coming up with like a thumbnail design for a video. And I think it was like, I specifically remember using the term degenerate in it. And it literally had like just picture of just like a regular dude, like a regular corporate looking dude. And that was like somehow tied to degenerate. I actually love that. Lauren says 1 million seconds is like 11 days and 1 billion seconds is like 31 years. So now we need 100 billion. So we could do the time thing. I think that's a good way to contextualize it. How long in seconds is 100 billion? Well, I guess I should, how long in days? That's my bad. I'm going to fix that. How long in days is 100 billion seconds? Let's see what Grok has. This one should be within its wheelhouse. It's going through the math, but we are starting. It's 86,400 seconds in a full day. Sounds right. Okay. So 100 billion seconds is 1,157,407 days in 9.77 hours. That's 100 billion. 1.2 million days. Yeah, 100 billion is a lot of fucking money to make in a quarter. Cliff notes. Accelerating growth in revenue comes from a court ruling from the Justice Department's monopoly case against Google's dominant search engine, widely seen as a mild rebuke that wouldn't hobble the company. Yeah. I mean, Ask Jeeves is fucking gone, ladies and gentlemen. I don't know if it's actually like gone, but I ain't seen nobody use that. What a great search engine. And it's gone. We lost Ask Jeeves. That's unbelievable. The gain supplement a 30% surge in shares created 770 billion stockholder wealth since September. So this is just everything going on in absolute tear. Part of this, again, is the tailwind. And this is also something Big Daddy J-Pow spoke about, which was AI, because somebody, I think, had asked a question about the correlation between like the .com bubble and AI. And as always, you know, we did the whole, this time is different, but I genuinely do believe that this time is different. I think that the AI, the capacity from AI is just completely different and scaled differently than the internet. And again, the internet was huge, but one of the things that we have to remember, like pre and post internet, was the information gap. That's something that I don't think gets spoken about quite as much. And if we think about what causes a bubble, part of it is an information gap. Now, if we have, let's say, like pre and post internet, so this is pre-internet and then post. Before internet, the way that you got quotes was from a newspaper, end of day. And there were like quarterly publications with technical analysis and charts for people to refer to. So everything pre-internet had a ton of latency. If you think about what latency is, that's what leads to these pockets where everybody's, you know, trying to climb up this hill. And then by the time we realize that there's a cliff on the other side, there's just so many people that they just start pushing each other over the cliff. There's just too many people at the top of the hill. That's kind of what happens in high latency environments. Everything is moving up this as fast as they can. Then they realize, oh shit, this is bad. And then it's too late. A big change post-internet is that is not really there anymore. Then there's also the slew of different market forces that have changed. Not all dampening, by the way, because if you remember at the beginning of the stream, I explicitly mentioned that volatility has actually come up, and it's partly due to this. It's because now the inverse of latency would lead us to initially believe that pricing would occur more smoothly and more regularly. The problem is it's not just price discovery that's occurring in markets. There's other things that are going on with a lot of leverage. That stuff can be distorted and moved super quickly. Think of the flash crash that was in the 80s. That stuff is real. So I can't help but think the broader change here from AI compared to the internet is the entire landscape objectively is different. Now, does that mean, as always, that there couldn't be a bubble? Of course not. Absolutely can be. There always can be. But it definitely might rhyme with the .com bubble, but it would be different. Very much so. And that's not like some crazy concept. It's just we're objectively in a different landscape. The other thing I wanted to show you from the tech side was the movement in Nokia. This was awesome. And I actually talked about yesterday. I was day trading Nokia yesterday based on the news. And I'm thankful I did what I did, which was take most of the trade down on the day. And it had everything to do with the way that the price action was behaving near this top. I talked a lot about this top right here. Doesn't look like much, but with everything else painted into the picture, there's actually a lot of information in this kind of thing. And there's nothing secret about it, but when you see price behave different ways, you can come up with different, at least, expectations of what might happen. It's never any sense of knowing. I have no fucking idea what's going to happen. I could have looked at it at another major gap up and been like, well, fuck, there was more money. But as you know, I don't really trade like that. That's actually a really broken way to think about things that tends to be an issue for people that aren't confident in what they're doing. If you're not confident in what you're doing, those kinds of people are always looking at stuff at like the profits that could have been. And there's just not a whole lot of value in that. Now, again, if you don't have like a defined system, the value in that is getting you to take a closer look at what you're doing and to define things a little bit more. But under the general guiding assumption that most people, at least that listen to the channel, are aware of things like a trading plan and a trading log and those feedback loops and a process-based focus. This kind of stuff then all just becomes a piece of the broader puzzle each individual instance does. And that's actually what led to the way that I traded this. If I had saw this continue on super strong volume and hovering near the top here, I would have felt differently, but I didn't. There was a pretty significant rejection. Again, this doesn't look like anything significant compared to the rest of the candle, but that's still not nothing. That's a 5.5% drop effectively that occurred there. That matters for sure. So something else that I was paying attention to, the cliff notes of that, AI, I think, is still just absolutely early days. I think that we're at such a cool phase, and I still believe the number of millionaires that are going to be made from AI is fucking awesome. I can't wait. I literally can't wait to see it, because it's such a profound opportunity that's going to hit so many different elements of the market. And there's so many ways to play it. We went through that on one of the market deep dives or for the pro members, where we built literally an entire playbook on how to play the entire rollout of AI. And it's because even though AI is new, the way that technology is adopted is not that novel. So you can literally just sit there and think, how has other technology adoption looked like? How might that look like for something like AI? And then how could I play it? So we're still in the early days. We're still in the point where you're seeing companies like Micron starting to get uplift because of what they supply. We are still in the infrastructure phase. We're still in energy companies having to solve this massive energy demand. We're in the phase where I do believe at some point, these fucking nuclear companies are going to start looking really good again. They looked great for a while. Like, this move here is massive. We went from 15 up to 50. And then it's just been sideways ever since. So the reason why I say that a little emphatically is because I really think these companies are super cool, what they do. And I genuinely want to see the technology roll out. I think it's awesome, but it obviously just takes a little bit of time. And I obviously want to trade it as it's happening, but this is actually starting to set up okay. Not great, but okay. We'll keep an eye. And it also has earnings. When are earnings? The 6th. So yeah, we'll see. Earnings plays today were good. They were pretty solid. There were a couple that fell relatively flat, like KHC and Etsy. Those fell a bit flat. And then CZR was a loser, as was BE. But CNC went well, V went well. So there was a bunch of offsetting stuff. BA went well, AUR went well. There's a bunch of offsetting stuff that ended up turning out pretty well. So the earnings season so far has been like really, really solid. We have a bunch of plays outlined for tomorrow. We went over all those yesterday. It's a little bit of a smaller list than compared to today, but looking at tomorrow, I see 1, 2, 3, 4, 5. I see 5 that are viable for entry tomorrow. For entries on today, there's 1, 2, 3, 4, 5, 6, 7, 8. So a little bit of a heavier day today than tomorrow. Typically the Thursday PM, Friday AM expirations slow down a bit. So that's what I got for you guys. Talk to me. What do you guys want to talk about? Kirk says, what was your vol sampling method on today's intraday short strangle? Did you do similar vol sample when you reset the deltas? Yeah, I have a couple things I do. To be honest, it's part of my secret sauce, so it's nothing that I would outwardly disclose. But yes, the vol sampling that I do is essentially done perpetually throughout the day. And then I have different ways that I internalize it based on different time frames. And then I have a couple different ways that I look at it to create comparisons, because I do not think that I can forecast vol better than the market, but vol does have a bit of a momentum component to it. So I pay pretty close attention to that. Level says, I've been using the unusually bullish flow on unusual whales, and I've noticed traders buying 30 DTE call options about 15 days before earnings. I'm trying to understand the reasoning. If they were trying to profit from the increase in IV before earnings, I'd expect them to pick expiration that included earnings date. That's a good assumption. The next one is, and if they were betting on a big price move after earnings, I'd expect them to buy those calls closer to the earnings date, not 2 weeks earlier. Yeah, those are good assumptions. I think the issue that you're having there is you're just looking at it way too flat, way too unilaterally. What I mean by that is the compulsion of a market participant can literally be a million different things. And the other thing is, even in terms of what the calls are in terms of like their delta and what the vol looked like in them, those have places in trying to figure out and decipher what they might be. I very rarely would ever use like one series of purchases of calls to inform some sort of decision making. More often than not, it's like a contextual piece. Now, that being said, there absolutely can be instances where that's like some sort of tip off that something interesting is going on. Let me see, which screener did you say you're using? Let me see. Unusually bullish flow. Where the fuck is that? Not here. Oh, here we go. Whoa. Don't need a tutorial. Thank you, though. Where's the unusually bullish? I don't see that one. Where's that at? Option screener. Thank you. There we go. Hell yeah. Thank you. Let's see. So the first thing is anything that you see typically that's in the money, not super interesting. The out of the money stuff looks a little more interesting. The super long dated stuff, don't care so much about. So you're talking like these right here. These are the only 30 DTEs that exist, at least as of right now. So these are AMRZ in 21 Nov. Yeah, I mean, there's nothing really directly from this that I'm pulling away, but we can take a look at the broader picture. Like, that's pretty bullish looking to me. That's also strange. That's really strange. So these orders came in on the open, then were offloaded. The other thing that's kind of strange is this transaction. You can see that this was one big transaction from here to here, or, a series of transactions that effectively occurred like after this move, which is a little bit abnormal. So yeah, I mean, there's a ton. It really takes a lot to look at this stuff and then to come up with like decent systems around. Because the one thing that doesn't work well is to look at stuff and then to just kind of generally be like, oh, like I kind of feel like blank. That doesn't work well. What I would do is I would try to parameterize it and then track it, because I definitely use options flow for sure. It's not a primary factor, but it is a strong supporting factor for stuff. That's a lie. Sometimes it is a primary factor, but infrequently so. Every once in a while, I will see order flow that just based on the order flow and pure psychotic interest, I will come up with something, but that's definitely more the exception than the rule. In general, it's a supporting factor, at least for the main profit mechanisms that I'm looking to attack. Now, with that, there's a lot you can pull from this stuff, but it typically needs to be put into context with other stuff. Otherwise, I think it has a potential to just drive a lot of noise. Like, for example, a really, really good study to do. And I actually wonder, because they typically let you go back in time. Yeah. So for somebody that's enterprising, all I would do is export the last 3 months. We could literally do it as an exercise sometimes. There's not that many. We could literally just export the last X number of months of whatever's on this list. And then we could see how they behave. Now, what I would do is I would export all of these different factors, though, so that then you can run some sort of logical factor analysis. Otherwise, it's just guessing, right? So like if we're like, oh, well, I noticed that this one thing moved and now I think that, that that's just the rule. It's a complete mistake. Even just a few months of data realistically is not enough, but it's a great starting point that, again, is accessible to everybody. So the exact way that I would do this is I would start, again, like for this month, and I'm sure that there's some way to export this stuff. If not, I would just do a print screen. And if you do a print screen, then you can come up with a way to move this into a Google Sheet or whatever you want, and then to actually track the price performance of the thing. That's easy to do, right? The way that I would track the price performance is I would figure out whatever the spot price was at the time of entry, if this gives it to you, which right here it does, which is great. And then all I would do is figure out what price was 1 day after this, 2 days after this, 5 days after this, 10 days after this. Again, something super simple. And then see what kind of result you get. It's really not difficult to do, but that's the way that I would approach something like this to even come up with a very rudimentary understanding of how effective this specific filter is. I'm just not familiar with this specific filter. I have, as you saw in the other ones, like I have specific things that I look for that I do know are statistically significant, but I don't know exactly what the secret sauce is in here. This looks like a certain amount of premium, a certain multiple, a max DTE, which actually is kind of long, I think. I would even take that in further personally. But again, if it's somebody that doesn't know the relationship of DTE and this kind of price behavior, then keep it longer. But I kind of already know part of that. So it's getting rid of in the money, and then it's only looking vol over open interest. Like this is a completely reasonable, good starting point. So this is great. So the next part then is literally just exporting it. Let me see really quick. If we save it as a PDF. Perfect. So I just saved that as a PDF. Let's open that. and then we can literally copy the information out of it. Now, I would obviously make sure that like the full window is visible and stuff when you grab it as a PDF. Otherwise, you're not going to get everything and, you know, those stupid kind of details. But then what you can do is you can save it as a PDF. Then you can either just transform it immediately into an Excel file or Google Sheets, or you can manually copy and paste it over into a Google Sheet and then add those additional columns. And then what I would do is add another tab that allows you to download price data for the different names that you see here. You only have to download them once, so it's not like you have to do this a bunch of times. For the names that come up, I would literally have a checker on another tab that tells me which ones I need to download versus what I already have, and just run a really, really basic analysis. I'll actually add that to the stream for tomorrow, the skill dev, just because we're coming up on time. But that's like a really, really fun skill dev stream. So we could do something on like building a unusually bullish study, right? To assess these individual conditions and then to try to feature match them a little bit and see which ones are more predictive than others. So I am adding a to-do list right now for that. So skill dev, testing unusually bullish scanner output strategy. Cool. Now, the one thing that you can think about with something like this, notice how I didn't even mention any options. As soon as you add options to the equation, you absolutely are adding complexity. And you don't need to add options to this equation in terms of like what strategy would you use if you have a really good fundamental understanding of options. If you do, then that makes it a really, really easy scenario to work through, because then you can literally see the standard performance of things again, because you're going to have price differences as well. And then you can very, very easily determine like, yeah, okay, is this something that typically moves by 10%, by 5%, stuff like that. And then you can just pick a strategy that works for that. But let's find one that's not expired. Let's do like this one. And let's see. So like this is a good example of somebody that's lost a bunch of money. Which one was that? This one. So this is let's look at A-Lab first. So this is A-Lab. These were from 1 October. So if I go to 1 October, that's this day, then it actually looks like a bunch of those might have been offloaded here. So what is that, like a two-day thing? The thing that I'm showing you here is what I call the eyeball test. This is where I'm not doing anything complex. I'm literally using the machine learning element of my brain to just eyeball stuff. Do I see anything that looks interesting that even warrants another look? Now, that's something that is developed over time, but that's one. So let's take a look at the other one for did we just do A-Lab? Am I fucking stupid? Yeah, now we need ASML. This was also on 1 October. Now, this one's interesting because these don't look like these were unwound. Because there's a big purchase here, there's even more of a purchase here, and more of a purchase here. For sure. And now they are making money after they went through a phase of not making much. So again, just a single data point. And notice how I'm not sticking, like if I were to do this just eyeball, I wouldn't spend a bunch of time with like the stuff that's super far out in time. I would focus on the stuff that's in here. And again, remember, this was like 22 days at the time of. So there's also that part that you have to keep in the back of your mind. But let's take a look at this one from 1 October. That's weird. It looks like it's literally mostly on the sell side. Those would have worked well if that was on the sell side. I ain't sure. Let's take a look at one more. We'll look at DraftKings. What is this one? 22 days. Fall over, I was 124, which is not a ton. 1 October, those would have got smashed. Those effectively went to nothing. So this is the way that I would do the exercise, so that now that eyeball a few of them, just kind of see what it looks like, see if there's anything that looks moderately interesting. Again, another way that I could quickly eyeball this is I could take this down to like no more than 40 days to expiration, keep the window really tight, and then I could sort by volume over OI. And then maybe in my mind, I'm thinking, is there a correlation between volume over OI and price behavior? Which, fun fact, there is. There's specific nuance around it that matters, but in general, there is a correlation. And if we take a look, we can see this is actually kind of funny, because there would have been a really good profit opportunity anywhere in here, but it doesn't look like that's been unwound in CDZI. It looks like there was a bit of an unwind here, but that's like flat. So that would have been nothing good, although there definitely was a profit opportunity. So one thing I'm noticing is that if we go to the 2nd of October, we moved 1 day forward. And I want to look at the value of the option maybe 3 days, 2 days to 3 days after, or maybe just the day after. This is day of. Yeah, so this is 1 day blocks. So day of to day after, value of the option itself went from, where's the fucking, there, 67 cents to 82 cents. Okay, so there's one. Take a look at another one in Meta. This is from 2 October. From the day of to day after, we went from 2019 to 1772. So we lost $3. Then we do that again with STX. Day of 2006, day after 2287. Again, like that's a day after. And you could tell this is the unwind right there. Like that is exactly what that is. This is a purchase on the 2nd. And you can tell because this candle is effectively the same fucking size, same everything else. That's somebody unwinding this position for a profit of $2.87, which is $287 per contract. It's a completely fair trade. That's not the stuff that you're going to see on Wall Street Bets, the YOLO bullshit, because the YOLO bullshit's cool, man. Like every once in a while, some motherfucker's going to hit and make a bunch of money, which is sick. But the reality is, for those of us that do this professionally, like that ain't it. Like that is not going to be something that you want to lean on long-term for your wealth. So that $2 that somebody made on their option, that might not be exciting, but it's effective. So this was day of $1.90, day after $2.12. So the first thing, just the very first thing that I'm ballparking here as I'm flipping through these one by one is, in general, as I look at these, the day after does tend to be higher. Now, again, this is a really small sample. I can't come up with some sort of really efficacious analysis. It's just the kind of thing where you can then say to yourself, maybe I should double click into this. I'm fucked up because I'm talking. What the fuck was I just on? Was it this one? Was this 2 October? Yeah, so we already did that one. We were on IonQ. The date scale fucked me up. Where's 2 October? Here. So 2 October, 592. Next day, 745. So that's up. So if I was just keeping a mental tally, most of these were up on the day after so far. Let's go to 2 October, 343. Day after, 323. That's a loser. So I would say 2 losers, rest look to be higher the day after. And next, and that's exactly how I would go about it. And once you finish that eyeballing component is when you can either get the specific data, because I'm pretty sure these guys have an API, so you could just pull the data from them, or you can do the simplified version using the stock equivalent that I was explaining to you guys a little bit earlier. All right. So there's one thing that I want to talk about, which was an interesting question from one of Ewan's books. And I gave an explanation that I'm not positive, like fully resonated, just because if you don't understand the terms that I'm using, then it might not actually make it any clearer. So I'm grabbing the question right now for you guys so that we could look at it together. This one. Okay. So this is a screenshot that they took from Ewan's book. And the question here is, okay, I guess I'm just fucking drawing on this. What the fuck? I thought there was a way to move this thing. There it is. Shit. It's Alt. Who would have thought Alt? Thought spacebar would have been the thing to move it. It says in the table where he shows premium due to volatility skew, he prices each option using the at the money implied vol to isolate skew. How do you do this in practice? When I try to replicate it using BSM, I'm missing the exact risk-free rate or the forward price adjustment. What's the most standard practical way to handle this part? The easiest way to do this is this is all baked in already. So if you can isolate each one of these components using the current options price. So for example, if I'm trying to back out what the risk-free rate that was used in these prices, I can easily do that because I know all of the other factors. I know every single input. So the cool part about it is you can literally break individual pieces out like that. Now, to get to something like the risk-free rate, just in general, the easiest thing to do is just use the corresponding duration debt instrument from the US Treasury. So, for example, if you guys have seen this before, where is my little handy-dandy workbook? This thing. So the pro members, you guys have access to this calculator, and then I have a video for everybody else to be able to build this calculator for yourselves. But a part of it is literally grabbing the corresponding treasury, T-bill, bond, depending on what the duration of the option is. So what I do is I build a tool that tells me the duration for these different things, and then I can figure out what the corresponding risk-free rate is for that time. And then if you go sub 30 days, again, you can still find that via using the SOFR rate and stuff like that. But that's how you get the rate itself pretty simply. And then beyond the rate, literally everything you can just derive out. That's the cool part about the Black-Scholes-Merton model with stuff like this. But the easier way to handle all of this is to literally just change the vol input. You don't have to change anything else. What that means is you can input the underlying details, and then you can have Black-Scholes give you the variables. Then you keep those the same. You keep all those the same. And then rather than using the individual strike vol, use the at the money vol. And then you just compare the premium between the two. So what that looks like is if we look at SMR, because we're in here, and I look at these 23-day options. The at the money, which again is really important to understand the difference, because there's a difference between at the money and at the forward. So in this case, 23 days out, we actually need to be out here at the 48. Even though the at the money looks like the 45, technically it is, the at the forward is the 48. So in this case, you need to use the at the forward. At this vol, we're looking at 123.47% for the out of the money, which is typically what you would want to use. You could do an average of the straddle if you wanted. That's also fine. But either of those, completely cool. From there, I can compare using that vol against whatever the vol is for the put or the call or whatever it is that I'm looking at. So for example, if I go out here to this 10 delta, the 75 call, the IV right now for that is 142.18%. So all I would do is I would price this option First, using 142.18 just so that I can actually figure out what the theoretical value is, because this bid-ask spread is fucking gross. And then from there, I would just, instead of using the 142.18, motherfucker just moved 143.81. And instead, I would use the 124.44 vol to price it. And then I would compare the difference in those prices. That's how you can easily identify what the skew is. And again, there's an even easier way to do it. You don't even need the option price. Option price, this is just Ewan's way to try and help. Oh, fuck. There we go. This is just Ewan's way to try and make the concept more visible and approachable to people. But the volatility skew can literally just be visualized using ... fucking volatility. So if instead of going through and trying to Black-Scholes Merton all of this, again, I think it's a good exercise, definitely worth doing. But you don't have to do it. You could literally just say, well, what's the at the forward? The at the forward is the 48 now, which is at a 126.56. That's the vol. So then I plot that point. And then I go to something that's further out of the money. Maybe I go to this 23 delta. What is that? 131.46. Plot that vol. And again, you can build your own little calculators to even eyeball this. Sure, I have one of them fucking somewhere in here. Here, that's term vol. So this is visualizing the skew for something. I have no idea what we were looking at this point in time, but there it is. So you can plot your own version if you're so inclined, or if you have a half decent platform because you're not using fucking Robinhood like a degenerate, you should be able to plot vol on your own. And not only can you plot vol, but you could plot the surface. So this is not just looking at the one expiration. This is looking at multiple expirations. But again, to get to the problem set that person was asking about, if I go to 21 Nov, boom, there's the smile. I can now see what the skew is right here. This thing is put skew, pretty heavy put skew. Does that surprise me? No, it's coming into earnings soon. And this is a heavy institutionally sponsored stock. So it's going to be held by a lot of people. People are going to want to buy puts, especially coming into earnings. People are purposefully willing to overpay for that. So then the people that are selling those puts are going to demand that premium in order to sell the puts. Boom, put skew right here. This is not always the same in other stuff. You can find specific names where the risk is actually perceived to be to the upside. Sometimes that's why I came to Tesla. Sometimes it's Tesla. There's other names that I'll show you that sometimes have this. GameStop is another common one that tends to have some level of call skew. Now, again, the tails always get hyper distorted, but that's a super tradable kink, by the way. That's probably bid-ask spread that has that thrown out that far, but there you go. So 19Ds, call skew. This is the inverse. This is where the market is pricing in a higher severity, but a lower probability to the upside. You can derive that literally by just looking at the smile here. So super, super useful tools. I love that question, which is why I wanted to spend a couple minutes chatting with you all about it. So I hope that that's useful, but it is time for your boy to bounce, be an outlier. See you guys later.